Governments always tell you they're working for your own good. They talk about financial freedom, stability, growth, and opportunity. You hear the same lines on television, at election rallies, and in official statements. It sounds reassuring, and naturally you want to believe it. But if you look at history a little more carefully, a little more calmly, you start to see a deeply uncomfortable picture. Because for centuries, governments have applied similar financial methods while putting people under pressure, concentrating money and power at the top. And almost none of these methods are new. They keep showing up again and again over hundreds of years. Only the names change, the details are refreshed, and they're presented with more modern, more innocent-sounding language. But the goal hardly ever changes: to move wealth upward and keep the majority dependent on the system. Let's start with the oldest and most basic method: inflation. When a state's tax revenues can't cover its spending, it really has two clear options. Either it admits it openly and raises taxes, which always triggers backlash and costs votes. Or, without saying it directly, it slowly reduces the value of money. In other words, it quietly makes the money in everyone's pocket worth less. People don't wake up one morning thinking, "Our money has been devalued." But they feel something is wrong when they go to the market, pay rent, or look at their bills. Ancient Rome knew this method very well. In the 3rd century, because of rising military costs and constant wars, emperors began reducing the silver content of the denarius. At first the changes were small, carefully made, so no one would notice. But over time the coin became almost entirely copper, covered only with a thin layer of silver. The state acted as if nothing had changed. It was the same coin with the same name. But in reality it was worth far less, and the people who paid the price were those holding that money. Prices rose quickly, savings were wiped out, and wages stopped being enough. No one was told openly, "We raised taxes, but everyone paid the cost." We explored this topic in much more depth in our previous video, Why Did Ancient Rome Collapse? If you're interested, you can check it out. Anyway, let's get back to today's video. This is why inflation is called a silent tax. The same thing happens today. Only now, mints have been replaced by central banks, and metal has been replaced by numbers. When we move into the Middle Ages, the method changes slightly, but the logic stays the same. This time we see forced loans. Kings in England, France, and Spain told wealthy merchants and guilds that they needed to lend money to the state. On paper it was a loan. In reality it was a demand. Those who refused faced fines, confiscation of property, or even prison. There was no real choice. Sometimes kings promised to repay these loans with interest, but keeping that promise was entirely discretionary. Payments were often delayed, made in devalued currency, or never made at all. Meanwhile, the state continued its wars, expanded its palaces, and preserved its grandeur. Merchants quietly lost their wealth. The trick was simple: present coercion as duty, loyalty, or patriotism. Those who objected were labeled ungrateful, or even traitors. This method worked for centuries because fear and propaganda were used together. By the 17th century, the system became more institutional and more respectable. In 1694, the Bank of England was founded. Today it sounds completely normal, but it was actually the result of the government's urgent need for money. England was at war with France, and it needed funds. The solution was to sell government bonds to wealthy investors. The state guaranteed interest payments on that debt. At first glance, it seemed profitable for everyone. The government found money, and investors received safe returns. But the hidden side of the story was this: Where did those interest payments come from? The answer is simple: from the public. They were paid through taxes collected from everyday necessities: salt, beer, bread, and other basic goods used in daily life. So the wealthy lent money to the state and earned steady interest, and the people paid the bill. This was a system of upward wealth transfer, presented as national finance. And it established a truth that still holds today. One of the safest investments in the world is lending money to governments, because behind the state stands the labor of the people. In the modern world, these methods became more complex, but also more invisible. Take budget deficits, for example. Governments constantly borrow and issue bonds. On television, we're told it's for roads, bridges, hospitals, and jobs. That may be partly true, but a huge portion goes to defense companies, corporate subsidies, and financial bailout programs. When it's time to repay the debt, no one starts at the top. Spending doesn't get cut. Instead, taxes rise, social benefits shrink, or inflation is used. The debt is presented as for the people, but the burden still lands on their shoulders. The winners are bondholders and large investors. Think back to the 2008 financial crisis. Banks took massive risks, packaged bad loans, and nearly collapsed the system. Then what happened? Governments stepped in. Trillions of dollars in bailout packages were announced. Where did that money come from? Taxpayers. And who emerged stronger afterward? The very same banks, but bigger, more powerful, and more too big to fail than ever. The logic was crystal clear. Profits were private, losses were socialized. And the public was told this was necessary to prevent a bigger catastrophe. Pension systems work in a similar way. People pay into them for decades, believing the money will be there when they retire. But in many countries, governments don't actually set that money aside. They spend it immediately. All that remains is a promise. Future generations will pay for it. When populations are young, the system holds together. But as people age and birth rates fall, the system begins to crack. Then the word reform appears. Benefits are cut, retirement ages are raised, or payouts are quietly reduced through inflation. If you look closely, everything is about perception. Inflation is called growth. Debt is called investment. Cuts are called reform. Language softens reality. People don't fully realize what they're losing. But behind the scenes, nothing really changes. Wealth continues flowing from the bottom to the top. These methods have worked for centuries because most people don't study economic history and don't understand how the system actually works. In recent years, things have become even more complicated. Concepts like quantitative easing entered our lives. Central banks created trillions of dollars, but most of that money didn't go into people's pockets. It went into financial markets. Stocks, real estate, and asset prices surged. And who owns most of those assets? The wealthy. For the average person, life simply became more expensive. The system was saved, but not for everyone. And then there are hidden taxes. Instead of raising income taxes directly, governments allow prices to rise. Through inflation, the state reduces the real value of its debt while people lose purchasing power. Your salary may look higher, but you can buy less. This isn't an accident. It's a natural outcome of how the system is built. Regulations often don't work the way they appear either. On paper, they exist to protect the public. But large corporations gradually shape these rules in their own favor. Complex tax systems, unreadable budgets, technical jargon. All of it makes it harder for people to see what's really happening. And if you can't see it, you can't push back. So why does all of this matter? Because the same things are happening today. Inflation is eating away at your savings. Debt is growing. Bailouts have become routine. The system protects itself. And more often than not, you pay the price. History tells us this. Methods change, but the logic doesn't. In Rome, money lost its value. In the Middle Ages, loans were forced. Today, inflation and debt are used. The mechanism is always the same. And the most painful part is this. Most people aren't even aware of it. They accept what's happening as normal. And that ignorance is the system's most powerful weapon. Because if you don't know the past, you won't recognize it when it repeats. That's why financial education matters. Understanding economic history is the first step toward protecting yourself. So always think about what's happening behind the surface. Ask who is winning and who is paying. Don't assume the system works for you, because history shows us something very clearly. Systems don't exist to protect people. They exist to protect themselves. History doesn't repeat itself exactly, but if you don't understand it, the results will still hit you. The same methods that impoverished Roman citizens are still being used today, only with more modern names and softer language. If you feel this video gave you something valuable, subscribe.